Welcome to the Daily Briefing from interest.co.nz. I'm David Chaston. Today we look at the growth in local authority revenues, we'll check recent movements in term deposit rates, update the latest risk premium data, and we'll wrap up with what the other media are reporting. Statistics New Zealand today published the June quarter details of local authority revenues and spending. And while both revenues and their surpluses fell back slightly from the huge increase in the March quarter, year on year the growth was still almost 3 times the rate of CPI inflation. Rates, fines and fees grew more than 8%, with rates alone growing more than 9% year on year. Total spending, including depreciation, was ahead a similar amount. The employee cost category was ahead almost 10% compared with June a year ago. You will clearly notice from our chart that revenue growth is usually restrained in the second quarter and really picks up in the third quarter. If we're starting at 8% growth, I shudder to think what it will be next time we review this data. Action from the recent Commission of Inquiry report to Parliament is sorely needed, but when it comes to restraining fast-growing public spending, you should not hold your breath. The Best Bank benchmark is currently sitting at 8.6% and is jointly shared by ASB, who have a 9-month offer at this level, and both ANZ and Kiwibank, who have a 1-year offer. All are structured to pay interest at maturity. Over the past week we have started to see 2 diverging trends. Firstly, the banks are backing away from higher rates, no doubt influenced by the sharp fall in benchmark bond yields and by the continuing rise in funds flows from retail investors. They don't feel the need to offer high rates when the funds are pouring in anyway. The other trend is that non-bank deposit takers are raising their offers. Not only are they losing out to banks, but they are realising that they need to offer their existing investors a higher premium to stay. This is a tough period for non-bank deposit takers, and we don't believe some of the premiums on offer are high enough yet to justify the risks involved. However, the 10% barrier is being broken by the second and third tier finance companies and should be being broken soon by the first tier ones as well. Among the institutions that have raised rates aggressively in the past week are Strategic, Equitable, Mascot, Asset and Geneva. Tomorrow the US Fed will review its Fed funds rate, and the market expectation is that they will reduce it by 25 basis points, 0.25%. One consequence of this expectation is that the gold price has moved higher, another has been the sharp shift lower for US Treasury note yields. Yields on New Zealand government stock have also moved lower. Such shifts show that the demand for safe and secure paper is as strong as ever. The discount to commercial paper is rising. In fact, the risk premium benchmark we monitor took another sharp turn up this week. It is now above 4.3%, more than double the benchmark US Treasury note, and continues on a steep track northwards. It's hard to know how high it will go and when the turning point will be reached. A lower US Fed funds rate will not hurt our currency either, and depending on what the Japanese central bank does tomorrow, it could reinvigorate the carry trade. And finally today, a quick wrap-up of some other recent news. High export commodity prices could mean fair value for the Kiwi dollar is up to 10% higher than it used to be, the Reserve Bank suggests. Standard & Poor's has launched a web page to help financial advisors and investors better understand the risks of investing in non-bank deposit-taking institutions. Bridgecorp boss Rod Petricevic and the failed finance company's other directors may face court action from the Securities Commission seeking compensation for investors who were misled by the company's prospectus, other offer documents and advertising. You can get more news and start with Newsmaker Views on our news page. Join us again tomorrow for the freshest finance news on the web. We'll see you then.